I'm used to giving this presentation to academic audiences, so it's really a pleasure to be here with you. I want to thank Ellen Brown for putting this together and Mark Armstrong. I've been a big fan of Ellen's for years, ever since her Web of Debt. I think it's so important here to understand the forces that have undermined our democracy, undermined our economic prosperity, and are destroying the middle class and harming the poor so much. And of course, the importance of understanding our own roles, our own responsibilities as citizens, as agents of change, not alone, but acting together. There's a recurring theme in American political history, the political struggle for control over the sovereign power of money, played out over the structure and governance of the central bank and the issuance of money. Jefferson, Jackson, Lincoln, both Roosevelts, and Kennedy in his own way, were all avatars who understood the dangers of delegating such broad powers to a private cartel of central bankers. The late economist John Kenneth Galbraith once wrote that for the first 150 years of American political history, the history of the Republic, no issue other than slavery was more hotly contested than the politics of money. And we see it play out with the interpretation of the Constitution on the first Bank of the United States with Jefferson squaring off against Hamilton. We see it with the second Bank of the United States with what was then, and probably still is, I'd say now more than ever, the most important veto in American history, Jackson's veto of the recharter of the second bank. We see it with the greenback that Lincoln used to help finance the Civil War. And then for decades after the Civil War, free silver, bimetallism, and then finally the Federal Reserve, which was founded exactly a century ago in 1913. William Grider, in his book, The Secrets of the Temple, talks about the creation of the Federal Reserve, the delegation to the Fed as being a turning point. So for 150 years, the first 150 years of this country's history, millions of Americans who weren't educated with PhDs in economics or finance, ordinary working folk, had very sophisticated views on money and banking. Again, no issue other than slavery turned elections as much as these issues. But it's when this power gets delegated to the Fed that the American people get told, this is for the experts. This is above your heads. Trust us, the experts will take care of it. And it really becomes an abdication of our responsibilities as democratic citizens. Now, I've got a Franklin Roosevelt quote here. The liberty of a democracy is not safe if the people tolerate the growth of private power to a point where it comes stronger than their democratic state itself. That, he says, is the essence of fascism, when government is owned by a group. In that same speech, this was from a 1938 message to Congress on the concentration of economic power, Roosevelt said, the second truth is that the liberty of a democracy is not safe if its business system does not provide employment and produce and distribute goods in such a way as to sustain an acceptable standard of living. Now, my interest in the Fed goes back many years from when I was an undergraduate student in economics, and I was fortunate to have a great mentor in college. Will Lyons was his name, the late Will Lyons. He was a disciple of Alvin Hansen, who really introduced Keynesian economics, the economics of John Maynard Keynes, to the United States. Later, as a legislative aide to the late U.S. Senator Paul Tsongas, I came to understand where the Democratic Party was going, unfortunately, in a very neoliberal direction. And during that time, I know last night, those of us who were fortunate to hear Matt Taibbi speak, Matt spoke about the beginning of Too Big to Fail in the 1990s when the derivatives market was deregulated, but really you could go back to the 1980s. In 1984, with the collapse of Continental Illinois and the Federal Reserve and the Federal Deposit Insurance Corporation propping them up. Now, for many years, I'd say it was a lonely road to be criticizing the Federal Reserve certainly during the heyday of Alan Greenspan's chairmanship. But times have changed rather dramatically. So what I'd like to do in the short time today is to discuss the Federal Reserve. What is it? What is its structure and its functions? Talk about the Fed's independence and the constitutional issues surrounding its independence, and what its independence really means, which is an agency that's been captured, and how that has contributed greatly to the economic crisis that we're in today. I'd also like to discuss some alternative paradigms that Ellen had referred to, essentially the Fed during the 1930s and 1940s, and how the Fed has responded to the present crisis and what the prospects for reform are. So first, the Fed itself, like I said, created a century ago. And its mandate, of course, is monetary policy and the setting of interest rates. It does that through open market transactions, the buying and selling, traditionally, of short-term Treasury securities. When the Fed buys Treasury securities, mostly from the big banks, it is essentially injecting liquidity into the economy to drive down interest rates. And of course, the reverse when it sells Treasuries. It is draining liquidity from the system to raise interest rates. And this can have a huge impact on the economy, not just interest rates, but through interest rates to employment and inflation levels, of course, gross domestic product. Its governing structure. Many of us think of the Federal Reserve Board, which is a seven-member board of governors based in Washington, D.C. Each of those board members, each of those governors, are appointed by the President of the United States for 14-year terms. So right there, a 14-year term spans more than 3 presidential administrations. It's longer than any other federal officer in the federal government. And yet, it's not the Board of Governors acting alone that conducts monetary policy. It's the board acting with the 12 regional Federal Reserve Bank presidents. So the Fed is organized in that's the list of board members, and there it is, 12 regional districts. Each district has a board of directors, and the board of directors, for instance, of the New York Federal Reserve Bank, is essentially a privately controlled board of directors, where the member commercial banks in that district that own the Federal Reserve are the ones selecting the boards of directors that essentially then select the president of the regional Federal Reserve Bank. And, excuse me, I'm losing my place here. There we go. And those regional Federal Reserve Bank presidents meet in what's called the Federal Open Market Committee with the Board of Governors to conduct the open market operations. Now, there have been a number of constitutional challenges to this. First of all, under the Constitution, it says the President of the United States shall appoint federal officers who are then confirmed by the United States Senate. However, these 12 regional Federal Reserve Bank presidents are not appointed by the President of the United States, so there have been repeated constitutional challenges that made their way up in the federal court system, claiming it was a violation of the Appointments Clause. The other substantive argument against against the Federal Reserve System was what was known as the private non-delegation doctrine, which reached its peak during the New Deal, ironically. The Supreme Court in 1935 used this private non-delegation doctrine to strike down the centerpiece of Franklin Roosevelt's New Deal at the time, the first New Deal, which was the National Industrial Recovery Administration. That administration sought to cartelize the economy. So when Roosevelt first took office, you recall, it was a time of the Great Depression. You had price deflation going on. And the idea of the National Industrial Recovery Act was to create industry trade councils throughout the economy, which would set minimum wages, minimum prices, a floor on prices, essentially. Now, the problem with this was that those trade councils were really dominated by the largest producers, the largest companies in each industry. Small producers were marginalized, labor, consumer interests, completely marginalized. And in a case that made its way all the way up to the Supreme Court, Schechter Poultry versus the United States, what became known as the sick chicken case, the court struck down this centerpiece of the New Deal. Now, Roosevelt criticized that Schechter Poultry decision because the grounds for the court striking down that decision were twofold. One, the court said that it was trying to regulate local economic activity and that this was not interstate commerce. But the second ground for striking it down was exactly what I mentioned, the non-delegation doctrine. Congress should not be able to delegate lawmaking power to private groups. When Congress delegates rulemaking authority, for instance, to the Environmental Protection Agency, at least it's delegating to a public agency whose budget is controlled by Congress. There's a lot of congressional oversight. The President of the United States appoints the EPA director. But it's another story when it's delegating to a private cartel, which is what the Federal Reserve System is. And in that Schechter Poultry case, Justice Cardozo, in a concurrence, this was a unanimous court decision, it wasn't even close, Cardozo called it a delegation-running riot. Now, within a couple of years, the Supreme Court changed its tune. Those of you who study constitutional law out there understand that this was a revolution in jurisprudence around 1937, where the court started shifting 5-4 decisions, basically upholding New Deal programs. And it's been said that they threw the baby out with the bathwater. The court started to recognize a more expansive interstate commerce type of power that Congress has, but they also just stopped giving that kind of scrutiny to private delegations. Last night, Gar Alperovitz mentioned that most liberals seem to accept delegations, that they look the other way at agency capture. And that's exactly what's happened with any kind of scrutiny of, I think, the delegation to the Federal Reserve. I mentioned there have been these constitutional challenges on both of these substantive grounds, Appointments Clause and private non-delegation. Every single constitutional challenge to the Federal Reserve has been dismissed just below the level of the U.S. Supreme Court by the D.C. Circuit, and they've been dismissed on narrow procedural grounds. The court refuses to rule on the substantive merits. The court will say that a private plaintiff, a private citizen, does not have standing because we can't show that we have personally been harmed directly by the Federal Reserve. Now, of course, that's because the Federal Reserve is not acting directly on us. It's acting through the member banks. It's conducting open market operations through transactions with its bond-holding banks. When it has been a congressional plaintiff, a U.S. senator who has challenged the Federal Reserve, claiming that he was harmed by not being able to advise and consent on a presidential appointment, the court has invented a doctrine that is little seen anywhere else in constitutional law called equitable discretion. It exercises its equitable discretion to dismiss and tells the senator, bring it up with your colleagues in the Congress. It's amazing it doesn't do that for other challenges to congressional actions. So what is the outcome of a central bank that is owned and controlled by a private banking cartel? We all learn at some point that central bank independence is good. It's good because we're taking the power of money away from politicians who are going to be swayed by short-term considerations to get reelected, and we're handing it to a platonic guardian, bankers who will look out for our interests, completely neutral and, unbiased by any self-interest on their part. And it is, I'm trying to choose my words carefully. Let's just say that central bank independence is a euphemism for capture by Wall Street. It is an affront to the U.S. Constitution. It's an affront to the Constitution, it's an affront to principles of democratic governance, and it's an affront to the rule of law. And not surprisingly, as a captured central bank, the Federal Reserve has contributed greatly to the present crisis. Now, let me see what I have here waiting for us. This just mentions the constitutional challenges. There we have Alan Greenspan, the cover of Time magazine, the Committee to Save the World. Alan Greenspan prior to becoming Federal Reserve Chairman, had been a director at J.P. Morgan, and of course an Ayn Rand devotee. He did more than any other chairman to undermine the Glass-Steagall Act. Now, the Glass-Steagall Act has been mentioned a couple of times here yesterday, I believe. Passed by Congress in 1933. It was part of Roosevelt's effort to break down that concentration of banking. Prior to Glass-Steagall contributing to the 1929 stock market crash, you had commercial banks engaging in all kinds of securities underwriting and dealing. Glass-Steagall attempted to put a firewall, very effectively for decades, between commercial banking and the casino economy, between commercial banking and security underwriting and dealing. And this was undermined first by regulatory interpretations by Alan Greenspan and a compliant judiciary which essentially deferred to the administrative agency. You see Robert Rubin and Larry Summers in that picture, and Robert Rubin came to the Treasury Department in the Clinton administration from Goldman Sachs. But he jumped from Treasury to Citigroup. And as Treasury Secretary, he and then Larry Summers helped to negotiate the Gramm-Leach-Bliley Act of 1999 that swept away the Glass-Steagall firewalls. And there we've got the signing of the Gramm-Leach-Bliley Act by a Democratic president. For decades, this was the agenda of Wall Street. For decades, Republicans tried to pass legislation to abolish Glass-Steagall, and it took Bill Clinton and his triangulation. There you see him surrounded by bankers and other politicians signing away perhaps one of the most effective parts of the New Deal. By the way, I used that photograph. I bought the copyright for it. It was a New York Times front page photograph for an article I wrote for Dissent magazine called The Legacy of the Clinton Bubble. Other things the Federal Reserve did to undermine financial stability, again, Matt Taibbi mentioned it last night. They were very instrumental, especially Alan Greenspan, in undermining the regulation of the highly complex derivatives market. The classic example, of course, is Brooks Lee Bourne, who had headed the Commodity Futures Trading Commission, attempting to bring this shadow financial system under regulatory control, and in 1998 being slapped down by the same cast of characters, Alan Greenspan, Robert Rubin, Larry Summers, and some others. And the unregulated derivatives market becomes a major part of the financial collapse of 2008. You recall credit default swaps, which have been likened to buying insurance on your neighbor's house. But it's not just you who gets to buy the insurance on your neighbor's house. Everyone in the world can buy insurance on your neighbor's house. So the credit default swap market is insurance on bonds, essentially. And the credit default swap market, at the time of the 2008 financial collapse, had a notional value of between $50 and $80 trillion. Several times greater than the gross national product of the United States, greater than the entire world GDP. As if that's not enough, the Fed was, at best, asleep at the wheel on the housing bubble. There are a lot of theories that maybe it was intentional, but at best, just asleep at the wheel. It didn't just push interest rates down to historic lows after the September 11th terrorist attacks, but it combined those low interest rates with very lax lending standards. And Greenspan had been warned by a fellow Federal Reserve Governor, Lyle Gramlich, to bring this derivatives, to bring some regulation to lending standards. And both Greenspan and Bernanke just completely ignored lending standards. So suddenly, instead of 10 or 20% down payment on a mortgage loan, mortgage loans are being made with nothing down, with no incomes, no documentations, and of course this is part of the securitization daisy chain where the risk gets sold off to pension funds in Norway and elsewhere. There has been much fallout from a captured central bank and much failure. We've seen inflation in a certain form, inflation of asset prices followed by asset price deflations. So this is the boom and bust of financial bubbles. I want to turn our attention to an alternative paradigm. Oh, there's the Bush team. And you'll see the Bush team doesn't differ that much from the Obama team. And there are a bunch of, you know, I don't know what it is, this pose of prayerfulness. Very devout. And Obama reappoints Ben Bernanke to head the Federal Reserve, and he reappoints the whole crew that brought financial deregulation. You know, I've been a lifelong Democrat until recently, and I've got to say, this is a party, thank you. This is a party that has been captured by Wall Street interests as much as Republicans, and in 2008, the Obama campaign raised more money than the McCain campaign. So it is part of the challenge that we're facing. Wall Street's, I don't know how that got in there. Okay, the alternative paradigm. Mariner Eccles, who chaired the Federal Reserve during the 1930s and 1940s. Roosevelt was elected in '32. Back then, the president didn't take office until March. And in February, a month before Roosevelt took office, the U.S. Senate conducted hearings on the financial crisis. And there were 150 bankers from around the country who all sang the same sermon. It's time for financial austerity, to cut budgets, to cut government spending at the federal level. And only one banker among them preached a different tune, and that was Mariner Eccles. Eccles understood that you had to put people back to work so that they could pay their bills, that they don't get foreclosed upon. He was Keynesian before Keynes's general theory. And Roosevelt promptly appointed him first as a deputy Treasury Secretary and then as the chairman of the Federal Reserve. So throughout the 1930s, I'll talk about that in a moment. The Fed actually contributes quite a lot to the New Deal programs and recovery. But I do want to focus some of our attention on the 1940s Fed. We're told that the deficit has never been larger. Government spending has never been larger than today. It's not true. Of course, World War II becomes the impetus, as Gar had mentioned earlier. You see, let me see here. Okay. This is federal spending as a percentage of GDP, almost 45% of GDP during the 1940s. Today, this is not actually accurate. It goes up to about 25%, so to this line here, and it's now coming back down. And of course, that spike of spending that goes up is partly the result of bailouts, unemployment compensation, the automatic stabilizers. Well, with all that federal spending, you'd think that interest rates might go up. Here's the deficit as a percentage of GDP. Today, it peaked at about close to 10% of GDP. So it would be that line right there. And it peaked there right after the financial collapse, 2009, 2010. It's now going down. It's now at around 6 or 7% of GDP. During the 1940s, 35% of GDP is where it peaked at, I believe. The national debt is a percentage of GDP. Today, it's actually up close to 80%. This is the national debt held by the public. Back in the 1940s, it peaked at 120% of GDP. So I don't want to focus too much right now on why the government was spending so much money, just the fact that the government was. It was spending and borrowing tremendously compared to any time since. What were the effects? Well, you've got the yield on 3-month treasuries pegged at 0.3%, as low as today. So let's see, the federal government borrows 3 times as much and yet keeps interest rates even lower. How can that be? It's because the Federal Reserve under Mariner Eccles purchased government securities in any amount at any price needed to peg the interest rate low. 0.3% on 90-day T-bills, 2.5% on long-term treasuries. Well, with such low interest rates, you'd expect asset bubbles, a stock price inflation, housing price inflations. Well, not exactly, because the Fed was a good regulator. It raised margin requirements. It said anyone who wants to borrow to buy stock has to put a lot of collateral down. Anyone who wants to borrow money to buy automobiles, to buy housing, has to put collateral down. The Consumer Price Index. This is throughout the 1940s. I'll say that during the peak war years, 1941 to 1945, consumer price inflation averaged less than 3% in the United States. Well, there were wage and price controls, and I'm told that's an infringement on the free market and all that. Of course, it's cracking down on cartels that have the ability to raise prices prematurely. I remember speaking at one conference and making this kind of pitch, and a former World Bank economist said, well, look, after World War II, after the wage and price controls were lifted, there was some inflation. And I said, okay, for 10 years, the federal government used these controls, fought a world war on 2 oceans and won it in 3.5 years, had the GI Bill of Rights during this decade, in which it took 16 million returning veterans and said you got a free, tuition-free college education anywhere in the world, plus living stipends, and had a Marshall Plan that rebuilt democracies all over the world, all over war-torn Western Europe. Do you think that's a decent trade-off? And he scratched his head and he said, yeah, it sounds pretty good. That's why it's called the greatest generation. And real GDP growth, I should say, during the war, it averaged 15 to 20% inflation adjusted. We've never had a period of greater economic success in the United States than the 1940s, when the Federal Reserve, as a practical matter, was not independent. I'm using an iPad here, and it keeps freezing up, so please excuse me. I'll say that the empirical evidence that's usually thrown by economists like to say that if a central bank is not independent, you're going to have consumer price inflation. And when you really bear down and look at the empirical evidence, they usually actually start those studies in the 1970s. They ignore the empirical evidence from the 40s, 50s, and 60s. And I've written about that in Banking and Financial Services Policy Report. So, you know, you look at this history, and it certainly suggests that there should be some degree of humility among professional economists. It's not found among professional economists. It's not found in the legal academy. But back to today's Fed. How has the captured Fed responded to the economic crisis? I already suggested the fact that the Federal Reserve is captured contributed to the creation of this crisis. It deregulated all the financial markets and fell asleep at the wheel, did nothing to stop a looming bubble. How did it respond to the crisis? Now, we know that there have been a couple of Government Accountability Office audits that were mandated by the Dodd-Frank Wall Street Reform Act, thanks to Senator Bernie Sanders from Vermont and Congressman Ron Paul, which suggests, when we're talking about reforming the Federal Reserve, that there are people on both sides of the spectrum, Americans who understand the need to break this agency capture. Those GAO audits, the first audit showed that the Federal Reserve made more than $16 trillion in low-interest loans to the Wall Street banks in the aftermath of the financial crisis, which is why Elizabeth Warren is saying, hey, if they can offer such low interest rates to Wall Street banks, how about to students? The next Fed audit, the next audit of the Fed by the Government Accountability Office showed pervasive conflicts of interest, where the banks receiving these low-interest loans from the Fed were also the same bankers sitting on the regional Federal Reserve Bank boards. Jamie Dimon at J.P. Morgan was one of the more notorious ones. How else did the Fed respond to the crisis? Not just opening the floodgates of cheap credit to Wall Street. They also had their QE programs, quantitative easing programs, which, truth be told, it's been said, the QE programs do not add a penny to the deficit. The Fed creates money out of thin air, so to speak. QE1, the Fed purchased $1.25 trillion in mortgage-backed securities starting in 2008 and mostly 2009. Now, in March, I think it was March or May of 2008, before the Lehman Brothers collapsed, before AIG went under, before Fannie and Freddie got taken over, there was an article in the Wall Street Journal interviewing Paul Volcker, the former chairman of the Federal Reserve, who tried to prevent the undermining of Glass-Steagall during the 1980s. And Paul Volcker was concerned because back then, in early 2008, the Fed was making loans to Wall Street banks and allowing them to put up as collateral mortgage-backed securities that might have been worthless at the time. And Paul Volcker said, this is troubling. the Fed is going down a road where it might start looking at the nuclear option of actually purchasing these mortgage-backed securities. And if it does, it calls into question the neutrality and independence of the Federal Reserve for favoring some segments of the market over others. And you know, the Fed under Timothy Geithner, who headed the New York Federal Reserve Bank, and Ben Bernanke, the chairman of the board, blew by that road sign. It went nuclear. It purchases over $1 trillion of mortgage-backed securities, and there's been no angst about its independence from anyone else on Wall Street. Its QE2 program, the Fed purchases over $600 billion of Treasury securities to try to push down short-term Treasuries. When it realizes that low short-term interest rates might not translate into low mortgage rates, it has its Operation Twist, where it starts trying to shift the portfolio of its holdings from short-term Treasuries to long-term Treasuries. It opens up swap lines for European banks, and then we're now in the era of QE3. And I'll tell you this, while QE1 and QE2 were going on, I was going around the country saying, before the Fed has a QE3 for Wall Street, it should have a QE3 for Main Street. And it hasn't. QE3 is now the Federal Reserve purchasing $85 billion of bonds each and every month for as far into the future as the eye can see, because this is supposed to go on until the unemployment rate is down at 6.5%, and who knows when that's going to happen. So $85 billion a month, you're talking about $1 trillion a year. Roughly half in Treasuries and half in mortgage-backed securities. So when you see housing prices taking off, you got to wonder, is the Fed blowing more bubbles? So the verdict, yes, the Fed has so far apparently prevented a complete meltdown. And I say so far because it could be blowing more bubbles. But it's also prevented any far-reaching reforms, any house cleanings. It's propped up this corrupt financial system. It has essentially given a get-out-of-free-jail pass to these big banks by propping them up. And it has been ineffective economic policy. Mariner Eccles, during the 1930s, said when you're in a depression, when you've got price deflation or, wages are falling, when you've got, essentially, let's call it for what it is. We are right now in a jobs depression. You've got mass unemployment, mass long-term unemployment, upside-down consumers, the same conditions in the 1930s. When you got that going on, Eccles said monetary policy is like pushing on a string. You can push interest rates down to zero, but you can't make people borrow. And the only thing to get out of that kind of a depression, according to Eccles, was fiscal policy, was the government having jobs programs and putting people to work. And that, amen. Amen. You talk about what worked in the 1930s, what put Ronald Reagan's father and Ronald Reagan's brother to work during the Great Depression, and it was the Works Projects Administration. And you got 1 million young men who were in the Civilian Conservation Corps clearing fire lines. Today, we outsource that to the timber companies, and each year we've got bigger and bigger forest fires. And, well, okay, let's move on. The prospects for Federal Reserve reform. Senator Bernie Sanders put together an advisory committee. I was fortunate to be on it, and it was a very interesting experience. Bernie Sanders had Stiglitz and Jeffrey Sachs and Robert Reich on it, Robert Reich. Before I talk about the Sanders Advisory Committee and the kind of reforms, I do want to say a word about the prospects for reform when you do have a two-party corporate-owned duopoly. It seems to me that nothing is going to change in this country under the Republicans or the Democrats. I'm sorry to say it as a lifelong Democrat. To me, it suggests the need for a third party united by core principles. A second party. We've got one party with a Democratic and Republican wing. Yeah, absolutely. But a new party united by core principles, where there's no compromise on the core principles, and if you adhere to the core principles, it survives the unlikely, unfortunate demise of any one leader. And we've seen this throughout American history. The populist and greenback parties in the 19th century, the progressives at the turn of the 20th century, much like today's Tea Party. They never took power, but they pushed the agenda by pushing one of the parties in a certain direction. Or, you know, there's always the example of Abraham Lincoln's Republican Party, a third-party movement that came out of nowhere and took power. And is this possible? I'm always told that forget third-party politics, it can't happen. Well, who knows? In the age of the internet and in the age of Occupy Wall Street, all I know is if things are going to change, there's going to have to be this kind of a movement. Last night, Birgitta Jónsdóttir from Iceland said, if we had the power to change things, what would we do? What is the world that we want? I wrote a piece for the American Prospect called The Federal Reserve That We Need, and I suggested it's much like the 1940s Federal Reserve that we had. So Bernie Sanders asked his advisory committee 2 questions dealing with the Fed. How can it be reformed in its governance be reformed? And secondly, should the Fed's mandate be reformed? Should it be given any different authority to deal with the present economic crisis? The governance reforms, the advice that Sanders got was reflected in a bill that he introduced. So far, it's gone nowhere. It hasn't gotten out of committee. Essentially, to remove the Federal Reserve Bank presidents from the Federal Open Market Committee. No doubt, the membership on all these, I see I'm getting a sign that I only have 4 minutes left. Okay, let me try to get through this. Membership on the boards should be diverse, whether it's the Board of Governors or any Federal Reserve Board. This builds on the work of the institutional economists during the 1930s, John Commons, Leon Kaiserling, one of the first chairs of the Council of Economic Advisors, who both talked about having a Federal Reserve that had a multiplicity of interests, labor, debtors, that wasn't just stacked with bankers, that would become a marketplace for ideas and a forum for countervailing power, in the words of John Kenneth Galbraith. So, in short, reforming the Fed means nationalizing the Fed. Gar talked last night about the need to be nationalizing banks or to speak about it. And reforming the Fed's mandate and authority. I mentioned a QE for Main Street. What would that look like? It would look like the Fed helping to fund state infrastructure banks. We heard yesterday from Scott Paul from the Alliance for American Manufacturing about our infrastructure deficit. Again, these kinds of QE programs don't have to add a penny to the deficit. They put people to work. By putting people to work, you're employing taxpayers, you're reducing deficits. A couple of conservative economists, Martin Feldstein and Vernon Smith, talked about the Fed supporting Fannie Mae and Freddie Mac to help modify mortgages. Student debt forgiveness or relief, the Fed could do that. And support for state and local government budgets. Ellen had mentioned the history of the 1930s. I'll just say briefly, the Reconstruction Finance Corporation and the Fed both helped finance these New Deal jobs programs. The Fed made loans directly to non-financial businesses in the 1930s, about $280 million. As a percentage of GDP, that would be like Fed loans of about $30 billion in today's terms. The Reconstruction Finance Corporation, created by Herbert Hoover in 1932, when Roosevelt was running for president against Hoover, Roosevelt said the Reconstruction Finance Corporation was a trickle-down approach because it was helping to support banks and insurance companies and not Main Street. As president, Roosevelt used the Reconstruction Finance Corporation for a bottom-up recovery, which Rob Call talked about yesterday. Roosevelt's Reconstruction Finance Corporation helped finance infrastructure, public works, mortgage relief for homeowners, and even local school teacher salaries. It made over $50 billion of grants and loans over a 25-year period. In today's dollars, that would be over $500 billion. Again, not adding a penny to the deficit, putting people to work, and reducing deficits. I'll leave with this thought, that what we see is an epic struggle that has been reawakened in our time. It's an epic struggle that goes back to the founding of this country, to Thomas Jefferson and Andrew Jackson, to both Teddy Roosevelt and Franklin Roosevelt. And perhaps reform is now the moderate position. You've got on one side what's considered an extreme view, to end the Fed completely. And I'm sympathetic to ending the Fed the way it is now, okay? But the status quo is unacceptable. It is a corrupt and failed status quo. This is from Occupy Los Angeles. I taught a workshop there. Al Smith talked about, Al Smith had once said, the only cures for the failures of democracy is more democracy. Some speakers yesterday alluded to the fact that maybe we're approaching a tipping point. And the late Tony Judt, a great historian, said that one of the great myths in history is that change comes slowly. It might look slow as it's unfolding, but he said change is more like ice freezing, not like ice melting. When it comes suddenly. I would suggest we are approaching a tipping point, that we are at the vanguard of change, that everyone in this room is part of that change, that democracy is in an hour of great need right now. And it's important for all of us to step forward, to do our part, to be foot soldiers in this change. As free human beings, we share a common destiny, a transcendent destiny, in the words of Emerson. Not pinched in a corner, not fleeing before a revolution, but benefactors and redeemers. We have to see ourselves as benefactors for future generations fighting for democracy. We have to see ourselves as redeemers of our broken democracy, so that once again this great land will have a government of the people, by the people, and for the people. We must and we will. Thank you.